Ladies and gentlemen, when you understand that the Federal Reserve does not exist for the stated reason that we hear in the news and the mainstream media, the dual-fold mandate supposedly to foster maximum employment and price stability, when you understand that that is not the real reason why the Federal Reserve exists or carries out its monetary policy, but instead the reason is so that the bank can bail out and support its own member institutions, the large multinational banks, when these banks get in trouble, then the world begins to make more sense. Then suddenly the actions that we see by the Fed actually start to look a little bit more rational, as opposed to the explanations that are given by the mainstream press. So let us take a look. Today was an important day in Fed interest rate policy. This was the first Fed rate cut in almost the last 11 years. So if you've only been following the precious metals or the markets for the last few years here since the 2015 bottom, you have not yet lived through a rate cut cycle. And let us just remember that the Federal Reserve does not have a magic lever. They don't have a special button sitting on Jerome Powell's desk. They don't have a form that they sign to just lower interest rates automatically. No, it's none of this. In order to, quote-unquote, lower interest rates, the euphemism, they must buy the short end of the bond curve. They buy it, they bid the price up, and what happens when the prices of bonds are bid up? The inverse, the interest rate, the coupon rate of those bonds is suppressed. Now, this would all be fine if they actually got the money to buy those bonds from a legitimate source. They could do whatever they wanted if they had their own funds to do that. The problem is that the place they get those funds from is from you and I and everyone else. Of course, they don't do it through taxation. They do it through the hidden tax that we call inflation. So they print money, or the electronic equivalent, from out of thin air. They type a few digits into a computer, they press enter, and they buy the short end of the bond curve with that fresh electronic currency, thus suppressing interest rates. This is how the Federal Reserve does it, and the why of why they do it is to support their own banks. Things will make a lot more sense when we just grasp that one fact. Welcome back, by the way. This is Christopher Aaron. It's nice to be back with you. It is early in the morning on August 1st, 2019, and let's cover the precious metals. Let's especially focus in on looking at the gold market this week. So the meeting, the first interest rate cut in over the last 10 years. Here's Jerome Powell, the head of the Federal Reserve in Washington, D.C. The cut came today at 2 o'clock, and I want to read this quote from Jerome Powell here today. In my opinion, this was the most important thing that he said. We want to pull toward lower rates to get inflation close to our 2% objective for the benefit of the American people. I mean, really, Mr. Powell, thank you for that benefit, the 2% inflation benefit that we all get each and every year, which is called a 2% tax that is actually the most regressive of all taxes because it hits those who can least afford it the most. Mostly the elderly, those on fixed incomes, such as pensions or retirees or Social Security recipients. So thank you very much for that benefit, Jerome Powell. We can see the result of a 2% inflation rate compounded. It takes $100, 35 years to lose half of its purchasing power at that 2% inflation rate. So they make it seem like it's nothing really significant, but in fact we're talking about a halving of in other words, dividing into a half the value of the currency every 35 years. I would say a system such as that is failing at one of its core mandates. If you think about the function of money, to be a store of value, to be a unit of exchange, to be portable, to be divisible, well, this is not serving as the very first of those aspects, the store of value aspect. Sure, US dollars are portable and divisible, but they certainly are not storing as a serve of value in this kind of way. So, thank you once again for the 2% inflation rate. Now, this is the hard part of what we're living through, is that if you pay attention to the mainstream media as they are discussing precious metals and interest rate policy, if you were watching the mainstream news over the last number of weeks, getting ready for this first interest rate cut in 11 years, these were the headlines. Look at this from July 8th. Precious gold rises as focus returns to growth and the Fed rate cut. And the important part here, so why was gold going to rise on the Fed rate cut? Because lower interest rates would support gold because they reduce the opportunity cost of non-yielding bullion. So lower rates means theoretically you would get less money for your US dollars, therefore lowering the opportunity cost of holding gold. That would all be fine, but it's completely bogus. I'm going to show you why. Another mainstream news article, gold scores gains for the week, for the day and week as the Fed reinforces the rate cut hopes. That was from just a couple weeks ago, July 12th. And then on July 10th, gold ETFs are pushing to the upside amid increased expectations of a U.S. rate cut, even as some investors look to lock in profits. Gold is believed by many investors to be inversely correlated with interest rates. Inversely correlated. Lower rates, lower gold today. I would say that is not an inverse correlation. That is a positive correlation. So we see, once again, the mainstream media getting it completely wrong, at least over the initial part of the day after that first rate cut in the last 10 years. The mainstream media saying that gold would rise after the rate cut, and here we see gold falling. Let's take a look at silver. Same thing for silver. Silver falling. Let's look at a cross-asset comparison here of 6 major world asset classes on the Fed meeting here at 2 p.m. We saw gold selling off early, an initial attempt at a recovery, and then more declines. Of course, the gold miners, you have to be really careful because the gold miners significantly leveraged the losses in gold today. So we were not chasing that recent rally for a reason. It's because I was expecting this sort of reversal on the interest rate cut. I was expecting the opposite to happen as what the mainstream media was telling us. Stock market was weaker today as well, so it seems like the quarter point interest rate cut was not enough for the stock market. Commodities and stocks have been quite strongly correlated in the positive direction, so both falling today. And ironically, what was higher? The US dollar. So all those theories about interest rate cuts hurting the dollar, that seems to have been wrong today because the dollar was higher, as were dollars in the future that we call US bonds. And that makes sense. The US bond, the long bond, is just the longer end of the spectrum that we are talking about from the short end of the spectrum that the Federal Reserve controls more directly. So be very careful when you're reading these articles from the mainstream press because they tend to get this relationship consistently wrong. Let us turn and look at where we are in the gold market. Now, as you know, this channel, we focus on technical analysis of the precious metals. So all of what we've just discussed are the fundamentals, and those are interesting, and those are what are driving this price action. As we look at the price of gold from late 2015 through the present, the fundamentals are driving this. The only problem with only studying the fundamentals is, for example, we've just discussed one fundamental, right? We've discussed interest rate policy and how that impacts precious metals. And maybe we can point to a few other policies that impact gold or fundamentals, such as the inflation rate or wars or trade wars. What else can we talk about? Mining supply, manipulation, all of these things, right? All of these fundamentals. So there's about 6 or 7 that I've just mentioned. But here's the only problem with fundamental analysis. What about the 6 or 7 factors that I don't know about? What about the infinite factors that I cannot possibly know about? So technical analysis is a philosophy of analysis that is based on admitting to ourselves that we cannot know everything that there is to know about a market. It is humanly impossible. And any time that anyone is cherry picking one fundamental and saying, well, what about this? Or you forgot about this, you can say, yeah, I may have forgotten about that, but what about the infinite other things that you are forgetting about? Because the market is the sum of everyone who would buy or has bought or will not bought an asset, and each one of those individuals is thinking an infinite number of potential things about that asset class. So this is a reflection of an understanding that we cannot know everything about an asset, and let us evaluate, therefore, the only thing that we really can know, which is the price and the trend in the price. So where are we here? We are looking at the gold market over the last 3.5 years. Everything here will be color coordinated. We are looking at the price of gold in the middle. At the bottom, this is volume. This is the number of contracts that have traded hands on a given day, and we're typically looking in the 30 or 40 million per day range. And up here at the top, this is a momentum indicator. So when this line gets above the 70 mark here, it's showing you momentum is quite strong, but perhaps a little bit too strong. Perhaps the market needs to pause or rest or reverse in the opposite direction for a period of time. Similar here, the bottom level, when this gets below the 30 level, this is generally an indicator that momentum is getting too strong to the downside and the market may reverse in the opposite direction. Of course, no system of analysis is perfect. None of these signals are going to be perfect, but no fundamental analysis is perfect either. So we are attempting to do the best we can here by aligning with visible trends. And so what are some of the most obvious things that we can talk about with this market? Well, first of all, let's talk about this massive 3-year resistance zone here shown in black, the black color, horizontal. This zone between roughly 1340, 1345, and 1378 on the upside, representing 1, 2, 3, 4 major peaks, and then a whole bunch of other minor peaks that couldn't get above this level over the last 3 years. And we will call this, therefore, a 2016 to 2019 resistance zone. Now, why have I put the arrow which says to support? Because what happened here just 2 months ago is that this resistance zone broke to the upside. We can see that very clear breakout here. And so this is now a resistance turned support. One of the most basic principles of technical analysis, and therefore one of the most powerful, because the most basic principles tend to be the most powerful ones, are that when you have a clear zone that a market could not overcome for a period of time that is then broken, we expect to see, when the market ever returns to that level, we expect to see second chance buyers show up in this region. The other thing that we expect is we expect to see those people who shorted gold here, who are now underwater on their shorts. In other words, they thought the price was going to fall and they were wrong because the price rose. When the price comes back here, those investors, all things considered, are expected to close their short positions. They are expected to close those contracts out, which means they have to rebuy those contracts, which causes the price to stop falling when we get back to this zone, back to the now support zone. So resistance turns support. Now, what else can we say? We have in these light silver lines, these Fibonacci retracement lines, shown here in silver. And these are measurements of the mathematician Fibonacci of the 14th century, who discovered that these ratios exist in many different aspects of nature, including hurricanes and seashells and the spiraling of the galaxy, and wouldn't you know it, in human behavior as well, in certain aspects. So we're looking at some logical targets here for potential Fibonacci retracements. The big ones, in my opinion, are 38.2 and 61.8. And isn't it interesting here that the 38.2 Fibonacci retracement of this entire move comes in at 1344, almost exactly matching the black boundary here of the lower resistance turn support that we measured independently. And so when you have two different levels that are corresponding within a few dollars and they're derived independently, it increases the support that should be expected to emerge at that specific level. 1344, 1345 going to be important going forward. Now, what's another obvious thing that we can draw here? The primary rising trend, blue, the primary trend from this August low in 2018 at 1166, connecting these major lows, this significant low. This level is still rising. And isn't it also interesting that this rising trend will be meeting with the horizontal support region by November of this year? So that's just, 4 months away? 3 months away now almost. So in sum, we have the rising trend, we have a flat resistance turn support, and we have a Fibonacci retracement here, all coming in at this same region. And what have we seen is weakness today on the rate cut. Again, in complete contrast to what the mainstream media was expecting. We saw the weakness. Now, this chart closed as of the close of the COMEX. That's why it only shows 1437, which was exactly when this was exactly half an hour after this was half an hour before the interest rate cut. So this chart does not reflect the interest rate cut today. And we know gold moved lower after the rate cut. So this chart does not reflect that yet. But in my expectation, what we've seen today in the after hours is that gold wants to be weaker after this rate cut. And I expect that over the next 2 to 3 weeks, perhaps most likely not more than the next month and a half, we will see gold continue to sell off and fall back into the confluence of this support zone as we just talked about. So this would be a very logical place to look for gold to come back into this support zone. And if it takes a little bit longer, perhaps it's not a straight fall, perhaps it's a decline and a recovery and then a further decline, this could very well match with the primary rising trend by the time that happens 3 months from now. So I would say if you are in the gold market and you're looking to make some new purchases, I would say do not go all in tomorrow just because the Fed has cut rates, because I think if you were reading those mainstream articles and you got misled, I do think there will be lower prices coming over the several weeks ahead. And we will look for support to emerge in this region, some stability. And then what should be exciting, as long as this support region holds, is that the next intermediate move should be higher. When you have a broken resistance level that comes back, and as long as that retest is successful, and this is what we will be evaluating here over the next several weeks, 1 to 2 months, as long as that retest of the support level is successful, in other words, those buyers show up again, we should expect the market begin to accelerate and finally clear this stubborn resistance here below 1434. That is the high expectation for gold over the intermediate term. Longer term, I remain cautious on the sector after we get to some higher targets. There are some red flags that I am still looking at that bring into question not those fundamentals that we talked about, not the fact that the Federal Reserve is systematically stealing from you and I 2% every year. None of that is in question. What's in question is whether the mainstream population is yet ready to wake up to this series of facts and begin taking action. Because as we know, the markets are largely a psychological phenomenon. It truly doesn't matter what the fundamentals are if people are just going to ignore the fundamentals. This is something that I've learned. And people can ignore the fundamentals for a very long period of time. So in technical analysis, we attempt to look at what actually is happening, not what we expect should happen. I expect that we will be making several trades in the gold market, perhaps as early as tomorrow morning or this morning if you're watching this on August 1st. I expect we will be making trades to capture some of the downward move, and then over the next 2 to 3 weeks, perhaps 1 to 2 months, we will be making the opposite trades at that support region to start profiting on the upside during the next move higher. If you would like to find out exactly the trades that we are making here, please know you can find out more about that on the home page in the Precious Metals Intelligence service. This is a premium research service, analysis service that comes out once a week with a once a month, just posted by the way, monthly video update. This just came out 3 days ago. It's very relevant to everything that is happening now. It's this format, but a lot more depth. The video was about an hour and 15 minutes that just went out. We cover not only what's happening in gold, but also in silver, also in the mining sector, also in the US dollar, also in the rest of the commodity index and the US stock market. That is all in that one video from 3 days ago. So get it while it's hot. We also cover the exact miners that we are going to be buying and selling here over the months and years ahead. You can find out all about that on the homepage, iGoldAdvisor.com. I wanted to tell you also, I work with individuals from across the spectrum. And just know this, I don't take any funds from any of the companies, any of the ETFs, any of the dealerships that we talk about. I am an independent strategist. I work only for my subscribers. I do not have a crystal ball, but I am an intense researcher and an independent thinker, and we work together to create a strategy session. We put it down on paper, something that makes sense for you, given your unique risk tolerance and time horizon, and we come up with that together. So I work with individuals across the spectrum, with those just beginning. There's no question too small, and those who are well advanced and looking to create a dynamic plan for diversifying across the precious metals. We work together by consultation, so know that you can reach me on the homepage if you are interested in that. Last, certainly not least, I want to thank those people who have donated to this channel on Patreon. It means very much to me. It's been an incredibly busy few weeks here. I will just let you know that the new service that I've been discussing, iGlobal Analytics, which is going to be covering more commodities, more than just gold and silver. I'm having to delay that, unfortunately, because of a life event that is requiring me to take care of a family member who is ill right now. And that has to come first, as you can probably imagine. So it's not the exact right moment for me to hit the launch button on the new service. Even though all the analysis is ready, I wish I could just get it out there, but there are a lot of logistics that have to go into that. So thank you for understanding about that going on with me. Once again, we're looking at gold being weak after the Fed rate cut. If you really stop and think about that, it is exactly the opposite of what the mainstream media was talking about for the last 2 weeks. It's important to try to think about this, and then to also bring into that the understanding of what the Federal Reserve actually is all about and their official stated purpose, which is quite different from what they're actually doing in the background, which is to act as a siphon on the productive capacity of you, I, and the rest of the citizens. Now, the good thing is that I firmly believe that over the long run, the Federal Reserve, or whoever it is that tries to suppress the power that is innate in us, I do not believe that they will be successful. In fact, I know they will not be successful because they are fighting against some of the most basic forces of the universe that are moving us in a direction of expansion and outward and upward progress. But over the short run, this Federal Reserve and those who are behind it absolutely can cause a lot of damage, a lot of distortions, and they can certainly grab their 2% or more every year, depending on how high the actual inflation rate is. So we must protect ourselves, and we must realize that the markets do not always move rationally over the short run. Thank you, and I will see you this time next week.